GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we bring you insights faster than businesses scrambling to rewrite supply chains. I'm your host, Jay Hamilton, and today we're joined by Jonny Matthews, macro specialist and renowned portfolio manager. Before starting Super Macro, his daily newsletter on everything macro, he managed 500 million in assets over at Brevan Howard. He's got 24 years of professional investing experience. And as we were saying before we hit record, he also was a degen gambler at one point, just like everybody that's in crypto now, even though he's not in crypto himself very deeply. But today we are going to discuss everything macro. We're going to get Jonny's view on where we are in the macro cycle. Where does he think we're going? What's the impact of tariffs? How much of a problem is the strength of the U.S. economy, or how much of a benefit is it to investing in the U.S. economy right now? What about the rest of the world? What's going on in other major economies? And then obviously also we'll talk a little bit about liquidity. Is liquidity coming? Where does Jonny see capital and money flowing throughout the short term, medium, and long term? Before we jump in, everybody, please just take a minute, subscribe to the channel, give us a like, give us a subscribe, give us a comment. Whatever you can do makes a big difference for us, helps the show grow and get in front of more people, and helps us bring on bigger guests. Now, without further ado, Jonny, welcome to the Milk Road Show.
Hi, Jay. Thank you so much for having me on. It's quite an honor to be invited onto this show.
Thanks, man. Appreciate you saying that. It's always great to get somebody from across the pond, somebody from the future. You know, I'm about 8 hours behind you, so you're seeing the world differently than I am right now.
I'm seeing the same stuff going on.
Okay, let's start with sort of high level. You know, you've been a professional investor for almost 3 decades, or decade and 2 decades and a half, and you've been through many cycles, more cycles than most of our listeners have been through. For a lot of our listeners, this would be their first, second, maybe third cycle. You've been through more. From your view, 30,000, 100,000 point view, where are we right now in the macro cycle?
I see the economy as still motoring along at full strength. And I'm talking about the US economy. This is what the economy that really counts. It ended the year with very solid momentum at the end of last year. Household real income is still growing at a very healthy pace. There are more jobs than unemployed workers, more available jobs than unemployed workers. Corporate and household balance sheets are in excellent shape. You know, they deleveraged after the financial crisis. Their debt servicing obligations, how much they pay to service the debt as a percentage of their income, whether it's corporates or households, is as low as it's been for decades. So things are really, really strong at the moment. And I think a lot of people's expectations are shaped by the experience that followed the financial crisis. A lot of people think we're going back into that low inflation, low growth world with low rates. And I don't think that's coming back again, possibly, and I hope not for the rest of probably not for the rest of my life. You've got some younger viewers, they may see it again, but certainly not in the short term. I don't see that coming back. So I'm quite constructive about US growth. But of course, there are impediments. And my biggest concern is obviously White House policy. We don't know if Trump genuinely believes that by threatening tariffs, he can bring manufacturing back to the US. I mean, that is, to me, that's crazy. I doubt very much it's going to happen. So is he threatening these tariffs as a negotiating tool to try to, tighten border security, reduce the flow of fentanyl from China, Mexico, Canada even? Or does he genuinely believe we can bring manufacturing jobs back to the US? That remains to be seen. But so far, the fact that he's given Mexico and Canada a 1 month reprieve is a good sign. Let's put it this way. There are certain industries in the US that would be really catastrophically affected if these 25% tariff hikes with Mexico and Canada took place. I was reading a report from the Cato. It's a Cato Institute, it's an economic research consultancy, talking about the complexity of the auto supply chain. And for example, a a car transmission system or an engine can crisscross the border between the US and Mexico or the US and Canada 7 or 8 times before it ends up in a car.
Oh my God.
Yeah. Now, if you applied a 25% tariff each time it came across
Each
the border,
time. That's crazy.
yeah. But even if it's just once, I mean, it would be just impossible to track, that. And even simple components in this research paper, they tracked the path of a little electronic component that gets imported on the West Coast, then to Mexico, to be put into a circuit board, sent back to the US, then it goes back to Mexico, backwards and forwards, ends up in a car seat, that ends up in a car. These supply chains are so complex and interwoven. It's just really, as far as I'm concerned, it's impossible to break them. And the idea that you may be able to get US workers to do these jobs that are being done in Mexico, I'm not sure what they get paid in Mexico, but perhaps it's like $5 an hour or something. Mm-hmm. You're not going to get those jobs. You won't get people in the US to work for that kind of money. So both countries are much better off. And this is a fundamental principle of free trade. Both countries could be better off. The Mexicans have more work, albeit it's lower paid, but it's probably good jobs compared to elsewhere in Mexico. And the US are able to focus on the higher value-added products, the manufacturing processes that require more complexity, perhaps a more educated workforce, and both parties are better off. So that, in a nutshell, is how I see the US. It's a really strong economy, and I hope that Trump realizes, if it ain't broke, don't fix it. Just he's inherited a wonderful economy, and all he's got to do is basically stay out the way and let it carry on.
It certainly seems to be the general consensus from at least our world and the guests that we're having on the show that the tariffs are a negotiating tactic, that it feels unlikely that, I mean, we'll see. Trump is obviously unpredictable, and nobody can put themselves in his mind. Only he thinks the way he thinks. But that seems to be the general consensus. When you talk about the US economy, what's driving the strength of the US economy? What has made them really take these leaps when so many other economies, which we'll talk about later in the show, are not in such a strong position?
Well, I can actually pinpoint one factor, and it is productivity growth. A Fed study between 2019 and 2023 looked at what the secret sauce was for how the US outperformed the other economies. And they looked at total GDP, the total growth in GDP over those 4 years in Canada, European Union, US. I think they might have included the UK. I don't remember. What I do remember is the thing that really, US GDP far outstripped the other major economies. And the thing that powered US growth was productivity improvements. Productivity barely improved at all in Canada. The increase in productivity was just purely driven by more people working. More people went to work. Each person didn't produce more stuff. There were just more people working. In the US, you had more people working and much better output per man hour, much improved output per man hour. And, the Fed researchers were trying to figure out how this could be. And it really, the conclusion they came up with was that in the US, there is a much more flexible labor market. And when the pandemic hit, 20 million people were fired instantly, just gone. I'm not sure about Canada, but in the European Union and the UK, we had all these kind of subsidies given to businesses to hold on to their workers. We wanted to retain the bond between the worker and their business. In the US, just fired everybody. Everybody got generous stimulus checks. They got unemployment benefits and so on. And people had time to find a job that was more suitable to their skills. And they called it a sectoral reallocation of labor. That's what they said was responsible. You basically threw everything up in the air. gave everyone a chance to find a job that they're better suited to, and for companies to find workers that were better able to do the jobs that they had on offer, and you ended up with a much more efficient workforce.
Very interesting. So growth very strong in the US, very strong, which sets up a lot of the markets that we invest in, particularly crypto, which is really denominated in US dollars mostly, sets us up very well. What about liquidity and inflation in the US? What are your thoughts on those factors right now?
Well, well, actually, this is very interesting. Of course, we had a period of very low, stable inflation between 1% and 2% a year in those 10 years or so leading up to the pandemic. Then we had the pandemic, and inflation really took off, not only in the US but everywhere else. And the value of fixed income investments really got destroyed over that period. I have a chart, with everything starting at 100 in, say, 2015, showing the performance of everything that is not the dollar, basically. So whether it's gold, crypto assets, equities, real estate, everything was an anti-dollar trade. And you can see the consumer price index, just going from the up and up and up. It really took off in 2020, made a strong, strong lurch higher, and carried on at a reasonably steep incline. But everything else, if you are out of dollar, out of fixed income assets, whether it's treasury bills or longer term treasury bonds, you did very well. You did very well. If you're a treasury investor, in terms of your total return over the last few years, it's been negative. It's been awful, absolutely awful. And I think, obviously there's still some kind of anchoring, some sort of biases, expectations of investors that we're going back into that low rate environment. I happen to feel that with the US running such large deficits, and with other countries, such large deficits, it's going to be difficult to get inflation back down to target. And although the Fed says, we're not going to change our 2% target, I think in reality, the Fed would be happy with a 3% inflation rate, as long as the labour market doesn't fall apart. I don't think they're going to try and drive inflation all the way back down to 2% if it means crushing the labour market. So we could be in an environment now where we have 3 to 4% inflation over the next few years, in which case investors need to think very, very carefully where they park their money. Investors look at overnight rates of, say, 4.25%, 4.5%, whatever they are, and think, well, okay, I better get out of these overnight rates, extend in maturity, because if the Fed's going to take rates down a long way, I need to lock in the fixed rate that's available on a 10-year Treasury bond, 4.4%. Let's lock that in while it's still there. But I think that could be a mistake. I think we could be in an era of, I'm not saying permanently, but persistently high inflation and higher rates.
It certainly feels like that is the direction that we're going. It almost it feels like we have created this environment as a result of consistent debt, growing debt, no solution to that, a need for the US government and other governments to continuously print money to try to deal with their debt, some form of QE. It almost feels inevitable that we're going to be in this period of continuously high inflation. Would you agree with that?
Well, yeah. I mean, I disagree. I think you said at the start of this that there's no way out of this. There is a way out. And
Okay.
After the Second World War, the UK, I think the debt to GDP was something like 260%. And the way we got out of that was a period of very high nominal GDP growth. So that's a mix of real growth and inflation. Because your debt to GDP is denominated in nominal terms. If there's 100 billion, let's just say, speaking round numbers, 100 billion of treasuries outstanding, and your GDP is 100 billion, you've got debt to GDP of 100%. If you can get your nominal GDP to grow um, at a reasonable pace, at a faster pace than you're paying interest on that debt, you've got a chance of reducing the debt to GDP ratio. And that's effectively what we did after the Second World War. And I think that is quite likely the way that the advanced economies will reduce their debt pile. It's been effective in the past, and I don't see why it shouldn't be effective again. And that means that we are, the central banks will perhaps go easier on inflation than they would have done in the past. They will allow inflation to run a little hotter as long as the economy is running hotter, and that way you can get your debt back under control.
Mm-hmm, mm-hmm. I want to let's chat a little bit about the rest of the major economies. We've focused on America so far. What about the rest of the world? What's going on in the other major economies that aren't in such a positive growth point right now?
I'm well, be wrong, but I do expect the eurozone to start showing more signs of life. Had weaker than expected GDP in Q4 at the end of last year, but household real income has been growing at a decent, healthy clip. Wage growth has outpaced inflation for the past year or so, and yet the savings rate, households have just been saving more of their income. So we haven't really seen a big pickup in consumption. I'm hoping that with a bit more political stability in France and after the German elections are out the way, maybe households will feel a little more comfortable about spending these gains. So I'm more constructive probably than consensus on the Eurozone. I'm quite concerned about the UK. I'm quite concerned. I don't know if you're aware, our Chancellor increased the company's national insurance contributions. This is effectively just a payroll tax, and the paid by companies on the salaries of their employees. And it went up by around 8.5%, or it will go up by around 8.5% from this April.
Wow.
Yeah, big jump. And on top of that, there's going to be a minimum pay hike as well. So total employment, when you look at HMRC, our tax collecting authority, they keep records of total number of payrolled employees, and that reached a record high at the end of last year, something like 30 million, something like that. It's declined by 30 or 40,000 for 2 consecutive months now. And what I think is happening is that employers, in advance of this payroll hike, are scaling back hiring, certainly, and maybe shedding a bit of labor. And it's not just there in the official statistics. I know anecdotally from small business owners that I know who are closing down businesses or, shedding staff where they can. I think it's a catastrophic policy that's been put in place by our government, but that's what we've got to live with, and that's why I am particularly negative on the UK.
So we've got Eurozone behind, but possibly picking up. French elections, German elections will be out of the way fairly soon. UK, that's pretty scary, that situation. I wasn't aware of that. What about Asia? What's going on over in Asia?
Well, I think the elephant in the room, of course, is China. And, for all these stimulus efforts at the end of last year, it's the data more recent data that we're seeing, it's not very convincing that they had much of an impact. The purchasing managers' indices, most recent ones, were slightly weaker than the prior month. I don't think anyone believes the GDP figure for last year. The Chinese, the PBOC has a 5% target, and GDP miraculously grew by 5% last year. So,
Sounds pretty sus.
Nailed it.
Right, it's that easy.
The real estate market there has been, declining for, something like 18 months. It's showing signs of bottoming out. But when you look at the prior experience of countries like Spain that had so much of their economy dependent on the real estate market, Spain did in 2008 and then was hit really bad by the financial crisis. China had a similar proportion of their economy dependent on real estate, either directly or indirectly. And now the market has, it's I won't say it's collapsed, but it's really, it's been declining for a long time. I'm not sure that the stimulus efforts that they've taken can really turn things around significantly. So, you can draw analogies with Japan from the late 90s, mid 90s, when it went into a very serious downturn. The real estate bubble burst, and they had periods of deflation, and 2 decades of stagnation. Really, I don't think China will be quite that bad, but the prospects are not good. Let's put it that way.
So when you zoom out, what does this say to you as an investor? How are you taking all this information of a strong US economy with we haven't even really talked a lot about Trump yet, but with a new office and a real accelerationist office that is really focused on pushing the economy, and they're already strong and looking like they could just get stronger. And then you have these other economies struggling. Like how do you process all that and take it into actionable inputs as an investor?
Well, I think what's interesting is some of the deregulation steps that the Trump administration is taking, I think may well be copied elsewhere. And there was an editorial in the Financial Times last weekend, co-written by Lagarde, head of the ECB, and von der Leyen, the European Commission president, setting out all the steps that the Eurozone needs to take to become more efficient and more dynamic. So, talking about deregulation, more open and efficient capital markets, and so on, really trying to replicate the kind of policies of the US more closely. And certainly, the financial regulations governing DEI policies, ESG investing, and so on, they are quite, I don't want to say ridiculous, but there are certain, I mean, they are.
They're heavy. They're constraining. They're not. Yeah, they are ridiculous.
I mean, now if you want to,
yeah, go ahead.
Sorry, if you want to label yourself an ESG compliant fund, you have to really jump through hoops, and then everybody in the market has to understand the regulations concerning ESG funds and so on, and be familiar with them. So there's all these compliance requirements on everybody else as well. Well, Trump's going to do away with that, and we'll have to follow suit. I think we will have to follow suit. And so a lot of the deregulation that takes place in the US may well be replicated elsewhere.
And are the other economies capable of that? To me, America is uniquely positioned because Trump is a unique human who has been able to achieve things very quickly because of just his ability to just push forward and kind of, for better or for worse, it depends your perspective. And I know it's not good for everybody necessarily, but certainly as an investor who favors open, free markets that have innovation and have opportunities, Trump is really pushing in a way that I just don't know if, like, can Eurozone do that? And China, definitely. Like, there's just no way that China could do that in my mind.
I think realistically, no. I doubt very much they can do anything like what Trump's planning on doing. They'll maybe discuss it, and some policy steps they will have to take. They will absolutely have to. They're not going to be anywhere near as dynamic as the US economy. Not a chance. But by the same token, Trump can't get away with just doing anything he wants. He certain things he's got to get through Congress. I know he's got this ability to use these executive orders and find something in the Constitution that allows him to just, just ram stuff through. But he's going to have legal pushbacks to some of his policies. But yeah, I mean, I do tend to agree with you. I think, the Republicans have got a majority in both houses, certainly for the next couple of years.
Yeah, for the short term. Yeah.
Yeah, so it's opportunity to do some big things in his first 100 days, to really leave his mark.
So where does this leave you then? So we've got a situation where it certainly seems like America is very set up. Great. They're at a great point right now. You've got this new rationalization from Elon Musk and Doge and all these things happening very quickly, which to me says, okay, is the gap just going to get bigger here? And does that mean that American equities and possibly crypto and the American tech, is that the place to be investing and to be focused right now?
Well, first of all, you hit on a number of things there. First of all, let's deal with the gap. Is it going to get wider between the US and the rest of the advanced economies? Not necessarily. Not necessarily. I think it'll just stay wide. I don't know if it'll get any wider. I think it's about time Europe really did some catching up. Japan is also looking quite perky now. So, I think there is the opportunity for the rest of the world to sort of keep pace, not allow the gap to widen. When it comes to US equities, we've just had two consecutive 25% year-on-year.
Can it happen again? Can it happen again?
No.
Like, is that even possible?
No, but then, if you'd have asked me this last year, I'd have said, no, it's not going to happen again. But
Right.
okay, but you have to take account of valuations. When you're valuing equities, I know this hasn't counted for the last couple of years, but generally we look at the PE ratio and we look at earnings forecasts. So forecast earnings over these 2 years have only risen by about 20%. The PE ratio has gone up by 30%. So the two things, we push the earnings up by 20%, and the multiple that we put on those has gone up by 30%. That's where you get your 50% increase in the value of US equities over those 2 years. I don't think you can push that much further. I think, I'm not saying it's a breaking point, and I'm not suggesting we're about to have an almighty pullback in US equities. I actually think US equities are going to have a choppy year, certainly a choppy 6 months. We're going to have these 1, 2, 3% pullbacks and then recover, and it's going to be difficult to trade that market. I think there may be better opportunities elsewhere. While the countries themselves don't have the same sort of growth potential, most of the large companies that comprise the major indices in Europe and the UK certainly, they are primarily exposed to the global economy, not the domestic economy. So you're not really, when you buy a UK listed company, it doesn't have much of a UK presence. It's primarily focused outside of the UK. So I think and these stock markets are on much lower valuations. There may be better opportunities there this year.
Interesting. Keep going.
Well, I was going to say, what I really don't think is that you want to do the super conservative approach of putting all your money back into cash to grab the 4.25% yield. You don't want to just move to the sidelines and say, oh, it looks too scary out there, I'm going to stick it all in T-bills.
Why do you say 6 months? What happens in 6 months? And I ask this because I'm kind of asking everybody this right now, because this seems to be a consensus, is that everybody, a lot of uncertainty right now. Yes, the setup is good. It seems like everybody's, pretty bullish setup in the US, but a lot of uncertainty. Trump, a lot of reasons why there's a lot of uncertainty, and liquidity is going down, not going up right now. So there's this, okay, seems like chop is the consensus for the next 6 months. What happens in 6 months though? Or when at what point do you think it changes?
A difficult question. And the reason I say, okay, for the next 6 months, I think we've got a reasonably strong economy is that anyone that really says, I'm looking my 1 year forecast or my 2026 forecast. I mean, it's nonsense. It's just not worth anything. Who the hell knows? Honestly, nobody's got a clue. And you do see these forecasts. I mean, all the central banks put out these forecasts for, their interest rate and inflation and growth and everything. I mean, you'll see it from the Fed at the March meeting. Nobody's got any idea what's going to happen out there. Really, none whatsoever. So for me, I'm just, I can say, okay, the next 6 months looks okay, but we have, obviously we've got no idea how things are going to evolve over those 6 months.
And then what about liquidity? Talk to me about liquidity for a second. Are we going to see coming into this year, there was a lot of people predicting, and as you said, predictions are like buttholes. Everybody's got one, but that's what we love on this show. I won't deny it. Uh, a lot of people predicting that we are going to see a surge in liquidity in 2025, with a big reason being this 4-year debt cycle. And we're coming up to a lot of that debt coming to maturity in sort of mid-year 2025 to into 2026. So a lot of people are predicting increase in liquidity, but right now liquidity is going down. What's your thoughts on how liquidity, are we going to see a surge in liquidity this year?
I don't, look, I mean, these the US debt maturity profile, it's continually being refunded. There's like 106 billion of coupon bearing securities mature in February, I think, and there'll be 125 billion issued. It's continually being refinanced, and pushed out to 10
Just kicking
years.
it down the road,
Kicking it
basically.
down the
Yeah.
road. Yeah, it's a continual process. So you don't run into a kind of a wall where everything's suddenly coming up to expiry and you've got to, somehow issue a whole load of debt. It's a continuous process. I don't see. I'm not an expert. I'm not one of these guys that follows liquidity and the monetary aggregates like M1 and 2 and 3 and all this. There are um, places that do that, but I've never found it. Never been able to interpret it and find it useful from a trading perspective. And the same for liquidity. Different measurements of liquidity. I just, very difficult. People warn about liquidity drying up or it's increasing or whatever. And I've never found it useful in my trading. I kind of focus on the bigger picture where I can.
Let's play out. You're obviously, being a long-time investor, you make decisions based upon probabilities and risk reward. Give us what are your scenarios? So one scenario is chop for the next 6 months. What are your other scenarios that are kind of bubbling around in your brain that you think might happen in the short to medium term?
I think it's a low probability, but it's priced that way, is that we get a resurgence of inflation. Maybe, maybe due to threats of tariffs, maybe due to tight labor markets, tighter immigration. It's difficult to find the workers that you want in the US. Wages start going up. Maybe we get an increase in inflation. It's a low probability, but it's priced that way. Nobody expects the Fed to hike this year. Let's put it that way. That's really a tail risk. But I think it is a genuine risk that maybe inflation starts to pick up again. And I don't want to underestimate the impact of these immigration controls, tighter immigration controls. For example, in the construction sector in the US, something like 30% of 26% of the workforce are immigrants, and roughly half of them are undocumented.
Hmm.
So that's one
Wow.
sector. Oh yeah, that's one sector
Wow.
right there. I mean, if you spend any time in California, you can see most of the construction workers, they are Mexican, without doubt. So that's one sector that is going to struggle to find workers that it needs. It's going to have to pay up. If there aren't the we say lower cost immigrant workers available, you've got to hire domestic workers, they're going to demand more money. And I think, you're going to see the same faced by the agricultural industry and the leisure and hospitality industry. Shortage of labour. And let's put it this way, something like 80% of the avocados that are consumed in the US come from Mexico. So, and there's a good reason for that. California can grow avocados, but you can't get the workers to pick them. So it's much more straightforward. Grow them in Mexico, get them picked and packaged there and ship them to the US. So I think these policies, these types of immigration policies, will have an impact on labour supply. Restricting labour supply should push the price up. So that's one source of inflationary pressure right there. Rationalising supply chains is another source. I mean, this is kind of a wake-up call. Whether the tariffs go ahead or not, the supply chains for some industries are so hugely complex that they are severely at risk from any disruption. I mean, we've seen it once before during the pandemic. You couldn't get semiconductors for the car industry. So, incrementally, we need to do something to rationalise the supply chain. The tariffs at the moment, Trump's increased the tariffs by 10 percentage points on China. Part of the reason that goods price inflation was virtually non-existent over the past 2 decades, prior to the pandemic, was that China was replacing more and more of the goods that you buy, or US consumers buy, with cheaper manufactured products. So, each year some other products were being replaced with something that was manufactured much more cheaply in China. But if that process goes into reverse, that will exert upward pressure on goods inflation. So there are all those impediments to getting inflation back down to the target. And to me, that is a risk that, the market's expecting 1 or 2 rate cuts from the Fed this year, more than 3 from the ECB. I think there is a risk that those rate cuts don't take place. Well, not to the extent that the market expects.
Mm-hmm. And if that played out, what would that look like?
Well, I think this is why we're going to have a choppy equity market. I think it will play out if growth remains robust. That's when you've got the biggest risk of that happening. So the equity market is going to be caught between 2 opposing forces. One where you've got solid growth, continued solid earnings growth, and disappointment that rates are not going lower. So, that will keep the US equity market in this kind of in a reasonably narrow range for the whole year.
Mm-hmm.
Those are the kind of that's a scenario that I think could well play out. Now the other scenario is I'm completely wrong about this, and what happens is I've been for the last 2-3 years laughed at on some of these podcasts by saying there's no recession in sight. Believe me, a couple of years ago that was quite a radical view.
Yes.
And now I still don't see a recession coming, but it's becoming more of a consensus view. What if I'm wrong and everyone else is wrong, and something happens, something causes a slowdown in employment growth? Maybe companies become really concerned by the threat of tariffs. They pull back on their capex spending, they pull back on employment, and so on. And things start going into a downturn, and consumers likewise become concerned over the outlook. Well, then all bets are off. Then you're going to see a really ugly situation where I think, obviously fixed income will rally, but everything from equities to crypto and everything else will decline. Gold will probably do okay in that scenario. I think crypto, the risk factor in it overwhelms the need for low interest rates. I mean, I just don't think it's got any correlation with interest rates at all. It's just, risk on, you buy crypto, simple as that.
Mm-hmm. Mm-hmm. Yeah. It's a difficult market to understand right now. It's certain. I mean, and that's nothing new. If investing was easy and understanding markets was easy, everybody would do it, right? We'd all be rich. Uh, but it feels like there is a not as much consensus as there was maybe last year around what we might see coming into this year. Definitely, there's a lot of momentum right now, a lot of momentum and a lot of excitement in just happening around Trump and the impact that he is having so quickly and delivering on a lot of the things he said. But it does it does certainly. How do you position? Are you pulling out into cash right now? Are you more sitting on this? I mean, you said you don't want to pull fully out into cash. I don't think anybody should ever do that. How do you position your portfolio right now?
That's a great question. I, if we rewind to the start of last year, there was also a lot of uncertainty and a lot of fears of recession. Um, and if you had a pretty strong conviction that the recession wasn't going to happen, you had great opportunities. Really, you could be short fixed income, you could be long equities, you could expect equities to outperform treasuries. There were plenty of things to do where the risk reward seemed to line up quite well. Now, I think the risk reward is not so appealing for that trade. I am still short of treasuries because my view is that the Fed won't be able to reduce rates at the pace they'd like to, and the inflation stands a chance of picking up again. My other strong view is on the pound. I have had some sterling put options, and on Monday, they'd sort of gone up by four times what I paid for them, and I I sold out half the trade, kept the balance. But by today, that's just gone to
It's
the
gone.
dollar's it's gone. It's just gone. It's like that South Park sketch. I don't know if you've seen it, where Cartman goes in to see the bank manager and gives him his money, and it's gone.
It's gone.
Yeah,
Oh my gosh. It moves so fast right now. So fast.
yeah.
Do you find,
Currencies are volatile.
you do you think that we're when you zoom out, a lot of these, cycles can be a year, cycles can be 4 years, cycles can be 10 years, 20 years. When you zoom out right now, do you feel like are we in a different time than we've been in previously in your life? Are we entering a new period? Like, do you see like these like larger shifts happening?
I think they're all different. I don't think, people like to try and do a kind of overlays, overlay a chart of something in the 90s with the current situation and say, well, okay, that's how it went then, and
Mhm.
this is how it's going to go now. But I think each cycle is different. Each cycle is really different. What I would say is this: that you've got to bear in mind that it takes really a lot, to put the US economy into a recession. The natural course of events is for people to become more productive and the economy to grow, um, and that's just the general trend. If you think about the recessions that we've had over the last, you know, couple of decades, it took a pandemic, it took a global financial crisis. You need something pretty catastrophic to drive the economy into a recession. The other thing that I would say is that leverage, just leading into that financial crisis, was pretty extreme. People were, I mean, anecdotally, you would hear in 2005 and 2006 of these fairly low-paid workers, maybe earning say $20,000 a year, buying $400,000 condos, several of them, you know, and lying on their mortgage applications, 100% mortgages, and so on. And the game at that time, and they were doing this for years. They were doing okay from it because they would just sell one and then they'd do it again and make money and keep making money. And more conventional householders that had a house with a mortgage and the value of the house went up, so they just remortgaged, took a bigger mortgage, and went and bought a speedboat or jet ski or whatever it is. So household leverage just kept going up and up and up. Corporate leverage was also very, very high, and as soon as As soon as things slowed down just a bit, as soon as people suspected the game was up, there was no way to get out of it. The housing market just collapsed. There was just no bid. You just couldn't get out of the house that you wanted to sell. We are nothing like in that situation today. We really aren't. And the average rate on all the stock of outstanding mortgages is 4%. People refinanced into lower mortgages as the rate went down and down soon after the pandemic. And when the mortgage rate went up and up, it's now 7%. They stayed put. They didn't move home. That's why housing transactions are fairly low. So people are looked into these very low rate mortgages. The mortgage is a very low percentage of the total of the value of the house. I mean, house prices doubled over the last 10 years. So, the average household is in great shape, and household wealth is at an all-time high. Household wealth to income is extremely high, and that's why consumers, there's not such a need to save as fast as they might have done previously. They can carry on consuming and enjoying their lives.
Mm-hmm, mm-hmm. Which would say everything's pretty good. I mean, certainly, I like the comparison to the previous collapses or the previous bubbles that have burst, and just knowing that we're not in that type of position right now. That is reassuring for sure. Jonny, it's been an absolute pleasure to get you on the show today. Really appreciate your time and your thoughts. Everybody, if you're not following Jonny, you can follow him on Twitter @SuproMacro. And also you can check out his newsletter if you want daily note on everything that's happening in the macro world. We'll throw a link in the show notes. Let us know how you guys feel about the current macro setup. What do you think about the US, the Eurozone, China? How do you guys feel? And do you want us to talk more about it on the show? As always, we do this show for you. Jonny, thanks again for joining us today.
It's been a pleasure. Thank you so much.
Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.